In 2026, California's housing market looks like a glittering mirage. On the surface, headlines celebrate million-dollar homes, coastal luxury, and resilient prices. But underneath, the reality is far more brutal. Across the state, there are cities where buying a home has quietly become financial suicide. Crashing prices, crushing mortgage payments, rising crime, failing infrastructure, and economic risks that real estate agents never mention are piling up. From inland cities plagued by instability to overpriced tech hubs standing on shaky ground, the California dream has turned into a nightmare for many buyers. In this video, we're exposing the 10 worst cities to buy a home in California in 2026. Bakersfield often looks like a bargain in a state known for sky-high prices. In 2026, the median home price sits around $368,000, far below the state average. But affordability is an illusion. Median household income hovers near $62,000, pushing the price-to-income ratio close to 6 to 1. That means most buyers are stretching themselves dangerously thin just to get through the door. With mortgage rates around 7%, a typical buyer putting 10% down is facing monthly housing costs of roughly $2,470 once taxes and insurance are included. That consumes nearly half of the average household's income. Add brutal summer utility bills that regularly exceed $300, aging homes that require expensive repairs, and a job market tied to volatile industries like agriculture and oil, and ownership becomes a long-term burden rather than an investment. Rising crime and growing housing supply only add to the risk, making Bakersfield a financial trap despite its low sticker price. Stockton has been here before. In 2026, warning signs are flashing again. The median home price sits around $425,000, but the city's economic foundation remains fragile. Nearly 1 in 5 homeowners is already cost-burdened, paying more than 35% of their income just to stay housed. Monthly mortgage payments easily cross $3,000, while violent crime rates remain roughly double the national average. Many residents depend on long commutes to the Bay Area, spending hours each day on the road. If layoffs continue in the tech sector, Stockton could see another wave of housing stress. Insurance costs are rising, infrastructure is aging, and investor returns are shrinking. Stockton remains stuck between affordability and instability, and in 2026, that balance is tipping the wrong way. Los Angeles is iconic, glamorous, and financially suffocating. In 2026, the median home price exceeds $1.1 million. To buy safely, a household would need an income well above $250,000, nearly 4 times the city's median income. Monthly mortgage costs can approach $7,000, even before factoring in maintenance and rising insurance premiums. Beyond price, quality of life is deteriorating. Homelessness continues to rise, crime has crept into once desirable neighborhoods, and infrastructure struggles to keep up. Earthquake retrofits, wildfire insurance, and property taxes add tens of thousands in hidden costs. Rental income doesn't justify ownership either, leaving both homeowners and investors exposed. Los Angeles in 2026 offers more risk than reward. Oakland's housing market has lost its footing. With median home prices near $865,000 and median incomes far lower, most residents are priced out before they begin. Mortgage payments exceed $5,000 per month, while prices have declined over the past 2 years. Crime, homelessness, and deteriorating public services have pushed buyers away. Many homes require expensive retrofits and repairs, and strict rent control laws have driven investors out. For the price Oakland demands, buyers are finding safer, more stable options elsewhere. In 2026, Oakland no longer offers long-term value. Berkeley carries prestige, but that prestige comes at a steep cost. Median home prices approach $1.5 million, requiring nearly $300,000 in annual income to buy comfortably. Yet property values have stagnated, leaving recent buyers vulnerable to losses. Many homes are old and expensive to maintain, often requiring seismic upgrades, plumbing replacements, and roofing work that can exceed $100,000. Strict rent control, high insurance costs, and ongoing quality of life issues make Berkeley one of the most punishing housing markets in the state. San Francisco remains expensive despite years of population loss. Median home prices hover near $1.4 million, while demand continues to weaken. Remote work has hollowed out the city's economy. Office vacancies remain high, and public safety concerns persist. Mortgage payments often exceed $8,000 per month, and strict tenant laws make investment unattractive. Even high income earners are questioning the value proposition. In 2026, San Francisco is no longer a comeback story, it's a cautionary tale. San Jose sits at the heart of Silicon Valley, but tech dominance no longer guarantees housing security. Prices remain near $1.3 million, while the job market has become increasingly unstable. Layoffs, automation, and hiring freezes have changed the risk equation. Home values have stagnated, ownership costs remain extreme, and any downturn in tech could trigger sharp corrections. Buyers are paying premium prices without premium stability, making San Jose a risky bet in 2026. Fresno is often marketed as California's last affordable city, but that reputation is fading fast. Prices have climbed above $400,000, while incomes remain low. Utility costs soar during extreme heat, water shortages persist, and job security is tied to volatile agricultural cycles. New construction has increased supply, but demand is weakening, putting buyers at risk of flat or declining values. Fresno's affordability story is unraveling. Riverside boomed during the pandemic as buyers fled coastal cities, but the consequences are now clear. Prices rose far faster than wages, and long commutes drain both time and money. As remote work fades, demand is softening and inventory is rising. Many buyers who entered at peak prices now face the threat of negative equity. Riverside's growth was driven by desperation, not fundamentals. Santa Monica stands at the top of this list. With median home prices approaching $2 million, ownership costs routinely exceed $10,000 per month. At the same time, crime, homelessness, retail closures, and declining tourism have reshaped the city. Strict rent control removes investment upside, insurance costs are extreme, and even wealthy buyers are questioning the value. Santa Monica has become the ultimate symbol of California's housing paradox: astronomical prices paired with declining livability. In 2026, California's housing market isn't just expensive, it's fragile, fragmented, and increasingly hostile to buyers. Choosing the wrong city could lock families into decades of financial stress, lost mobility, and shrinking opportunity. The California dream still exists, but only for those who understand where not to buy.